Hey guys, how you doing? Hope you're well. This is Alessio Rastani of leadingtrader.com. In this video, I'm going to share with you some very powerful and interesting information, which I think you're going to learn a lot from. So let's get started. Many folks have been asking, when is the next bear market going to start? When is the next market crash potentially going to start? And if it happens, if there is going to be another market crash, how will we know? And in fact, what does history say about a bear market? And how do we know what actually it's going to look like? So let's discuss this. You might have heard it mentioned in the mainstream media that a bear market starts when the markets drop by 20%. In fact, that's the standard definition of a bear market, when the markets crash or drop by about 20%. However, I'm going to show you, in fact, that this definition of a bear market is incorrect. It is not correct. In fact, there is growing evidence and a very strong argument that the correct definition of a bear market is a 16% drop in the stock markets, not the 20% drop that we've been told by the mainstream media. So the correct definition, guys, and in fact, as Jack Shanap of the Dow Theory argues, the proper definition of a bear market should be a 16% drop in the markets, not a 20% drop. That also means, by the way, that the correct definition of a bull market is a 19% rise in the markets, in the stock markets, not a 20% rise. So let's discuss this. Take a look at this chart, courtesy of the Dow Theory, which shows to you all the bear markets in history. So as you will see, the longest bear market, the longest market crash in history was the 1938 to 1942 bear market. And again, this is going by the definition of a minus 16% drop in the stock markets. And you will see that the shortest bear market in history was the one I remember back in my younger days. When I was 10 years old, we had the 1987 market crash. That, of course, was the shortest market crash in history. Then you got the 2007, 2008 market crash, which relatively, if you think about it, it's not even close. So we thought the 2007, 2008 market crash was quite long, but actually it was quite short in relative terms. And of course, the worst market crash in history, but certainly not the longest, was the 1929 to 1932 market crash, which of course led to the Great Depression. So you might be asking, why is this important? Let's take a look at this. According to an article that was written by Jack Shanap of the Dow Theory, he makes a very strong point and a strong argument for the fact that the correct definition of a bear market is a minus 16% drop in the stock markets. By the way, as you'll see here, it's quite a long paragraph. So what I've done for you to make things easier is to summarize all the main points in this image you see here. So what Jack Shanap says is this: when the stock market drops by 16%, again, the correct definition of a bear market, then this has resulted in declines of minus 24%, 80% of the time. That is actually quite interesting, but it's not as interesting as this, which is that 73% of the time the market has dropped by 16%. That has been followed by a recession. Wow, I mean, I did not know that. So what Jack Shanap is saying is that the evidence and statistics is showing that 73% of the time, when the markets have dropped by 16%, that has led to a recession. Now, there is more. He says the average loss for a bear market has been about minus 34% over a year and a half. Now, why is that important? That's important because the next time there's a market crash, we know now that the average loss is about minus 34%. So what we can do with that information is this. Let's say, for example, the markets were to crash in the next couple of years, okay? If the markets were to drop, let's say, by 34%, we know we're coming close now to a potential bottom in the market, okay? So the average loss for a bear market is minus 34%, according to the statistics. Now, let's continue. Jack Shanap also says that if we accept the minus 16% loss criteria for a bear market, that means that a plus 19% gain in the stock market is the start of a bull market. So 19% is just a reciprocal of a minus 16%. So guys, once again to summarize, the correct definition that we should accept for a bear market is not 20%, which is what the mainstream media tells us, or the financial news networks. Evidence and statistics shows to us that a minus 16% drop in the stock markets is actually the correct definition of a bear market. And for a bull market, it's 19% gain. Now, here is where it gets interesting. How do we know we're coming close to the start of a bear market? How do we know that a bear market or a crash could potentially start? And what Jack Shanap of the Dow Theory says is that one of the strongest indicators for the beginning of a bear market is consumer confidence. You see, history has shown that whenever consumer confidence becomes extremely high, that has led to the beginning of a bear market. In fact, as you will see here from this chart, bear markets start when the consumer confidence is at its highest. Okay, and in fact, he also says that the consumer confidence levels we're seeing right now in 2018 are extremely high. Why is that important? That's important because when you hear in the mainstream media that the consumer confidence and economy is doing really well, that actually should be a contrarian signal. So again, when the mainstream media tells us that the consumer confidence levels are extremely high, when the economy is doing fantastic, that is a signal for us to be very cautious and very careful. It does not mean we should sell. No, it does mean that we should be extremely careful and on guard. Take a look at this. This is a very powerful piece of evidence and statistic. What this research shows us is that whenever consumer confidence levels have been extremely low, forward returns have been positive. In fact, forward returns have been very good, as you can see here. That's why I've written here, low consumer confidence equals rising forward returns in the stock markets. However, take a look at what happens when consumer confidence levels become extremely high. Forward returns drop. Forward returns, in fact, fall when there is high consumer confidence. So guys, what this means is this, is that when we're told by the mainstream media or the financial news networks that the economy is doing really well and the consumer confidence levels are extremely high, we should be on the alert and be extremely cautious because history has shown that when consumer confidence levels are extremely high, forward returns in the markets have actually been falling. As you will see over here from this part of the table, again, high consumer confidence levels equals falling returns. But again, low consumer confidence levels equal rising and positive forward returns for the stock markets. Again, it's counterintuitive. It is contrarian thinking. And again, as good investors, we should be contrarians. It does not mean that we should be selling just because consumer confidence levels are extremely high, but it does mean we should be looking at the charts, looking at potential trend reversals, because the charts can often confirm what we're seeing in the consumer confidence data. And I personally don't think that the markets are going to form a top until we've hit 3,000 on the S&P. Again, I think that until the markets hit 3,000 and go slightly above it, we're unlikely to see a top in the markets. I don't think a bear market or a market crash is going to start this year between now and December. I think it's far more likely to start in the next 12 to 18 months, potentially in 2019 and by the start of 2020. Hey guys, I'm now in front of one of the best restaurants in Tehran and we're gonna check it out. So let's see how it is, right? Alright guys, we're going to try some tea, some Persian sweets, so dates. A show as well.
Welcome to Iran.